Three Federal Reserve presidents just voted against the President of the United States, not symbolically, on the record, in writing, inside the most powerful financial institution on the planet. And the window to position before the price action confirms what just happened is roughly 40 days. If you've got money in a savings account, a 401k, or any standard brokerage right now, drop what you're doing, because the next 18 minutes are going to matter more to your purchasing power over the next 2 years than almost any financial decision you've made in the last 5. If this kind of analysis is useful to you, hit the like button now. It takes 1 second, and it helps this reach people who need it. Here's what happened, and why almost nobody in mainstream financial media has connected the dots yet. On April 29th, the Federal Open Market Committee released its policy statement. Rates held steady, normal, unremarkable, until you looked at the bottom of the document. 3 dissents: Neel Kashkari from Minneapolis, Lorie Logan from Dallas, Beth Hammack from Cleveland. All 3 voted against the statement language, specifically against any language that signaled openness to future rate cuts. 3 regional presidents, 1 statement, 1 afternoon. The last time 3 regional Fed presidents dissented simultaneously on the same policy statement was during the Volcker transition in late 1979, when the Fed raised rates to 20% to break the back of inflation. That is not a footnote, that is the comparison. Before I show you what the historical record says happens next, and it is specific, I want you to understand something that the Fed story alone doesn't fully explain, because there's a second piece to this, and it's the part that changes everything. Comment below if you're already in any of the 4 asset categories I'm about to name. I want to see where people actually stand before I break this down. Jerome Powell didn't just hold rates. He made a structural move that most investors have completely missed. Powell announced he is stepping down as Fed chair on May 15th, but staying on the Board of Governors as a regular voting member until 2028. That decision sounds administrative. It is not. By staying on the board, Powell denied the current administration a majority of its own appointees on the Fed for the next 2.5 years. Stephen Miran, the most aggressive rate cut advocate on the board, is being forced out. Kevin Warsh, the incoming chair, inherits a Federal Reserve where the votes against rate cuts now structurally outnumber the votes for rate cuts in almost every realistic scenario. The president criticized Powell's decision publicly within hours. The Senate Banking Committee chair called it a significant mistake. The Wall Street Journal editorial board described it as a structural break from 75 years of post-war central banking norms. The Financial Times called it the most consequential single act of monetary independence in the post-Volcker era. Those are not fringe opinions. Those are the institutions that define the financial establishment, and they are all saying the same thing in the same week. Now here's where this stops being a political story and starts being a money story. 12 days before the dissents, Dalio appeared on CNBC. His exact words: "If Warsh cuts rates now, the Federal Reserve will lose its credibility." He said that before Powell announced he was staying, before Miran was pushed out, before any of this became public. The following day, in a Fortune interview, Dalio said, "We are certainly in a stagflationary period." Not predicting, confirming, past tense, already in one. And then he named the only mechanism left to close the gap between $7 trillion in annual federal spending and $5 trillion in annual revenue: currency debasement. Stay with me, because what Dalio described in that interview maps directly to 4 specific asset categories. And the historical data on what those categories do in this exact configuration is not a theory. It is a documented record across more than 100 years of monetary transitions. Share this with one person in your life who has money sitting in cash right now, because what comes next is the part they need to hear. To understand what the historical record actually says, you have to go back to the episodes that match this configuration precisely. In 1979, the same institutional conditions produced outcomes that are now public record. Gold returned 325%. Long-duration Treasury bonds lost 52% in real terms. Energy stocks returned 47% annually in real terms for 3 consecutive years. The S&P 500 lost 45% in real purchasing power. Not narratives. Documented returns. Then look at 1946 to 1948, 1973 to 1975, 2007 to 2011. Every major monetary transition over the last 100 years that matched these specific conditions. Fiscal deficit too large to close without debasement, political pressure on the central bank, institutional fragmentation inside the Fed itself, produced similar outcomes across the same 4 asset categories, not in percentage points, in multiples. Now here is the piece that almost no retail investor has seen. According to Dalio's published research and principles for dealing with the changing world order, his documented framework maps 4 asset categories that outperformed across every one of these transitions, not by prediction, by measured, recorded historical performance across multiple independent episodes. Bridgewater communicated to its institutional clients on April 30th, the day after the dissents, that the configuration now visible inside the Federal Reserve matches the pattern that preceded each of those windows. Here are the 4 categories. Exactly. And the accessible instruments for each. The first is energy companies with structural pricing power. The most direct instrument is XLE, the Energy Select Sector SPDR Fund, heavily weighted toward the 2 largest integrated producers in the United States, which together represent over 35% of the fund. Here is the mechanism, because the mechanism matters more than the ticker. When the Fed cannot cut rates and the federal government must finance a $2 trillion annual deficit through new debt issuance, the dollar comes under structural pressure. When the dollar weakens, oil prices denominated in dollars rise. Energy producers do not get hurt by rising oil prices. They are the rising oil prices. Their revenues climb directly with the commodity. Their operating costs, dominated by capital expenditure already paid, stay relatively fixed. Margins expand. Free cash flow accelerates. In 2022, when technology fell 30% and consumer discretionary fell 37%, the energy sector returned over 60%. We are now in a tighter version of that same configuration, with the additional factor of supply pressure on global oil flows. For a $10,000 portfolio, roughly 25% in XLE. 25,000 targets 6 to 7,000. 100,000, 25,000. Individual positions in the 2 largest integrated producers are the highest conviction expressions of this thesis. The second category is gold. The most accessible instrument is GLD, the SPDR Gold Trust. The lower-cost alternative is IAU, with nearly identical exposure and lower fees. Here is what most retail investors do not understand about gold in this configuration. Central banks have been the largest net buyers of gold for the past 12 months. Over 1,000 metric tons in a single year, the highest sustained pace in 50 years. They are not buying because they expect gold to rise tomorrow. They are buying because they expect the dollar to weaken structurally over the next 36 months. Saudi Arabia, China, India, Turkey, Russia, Poland, Hungary. These are not coordinated buyers. They are geopolitical competitors responding individually to the same set of conditions. When competing sovereign institutions converge on the same asset for the same reason, that is the strongest structural signal available in markets. The central bank accumulation pace accelerated further in the first quarter of this year. Every prior historical episode where this pace occurred preceded a major dollar repricing within 9 to 15 months. We are in month 1 of that window. Target 15% of total portfolio in gold exposure, $10,000, $1,500 in GLD or IAU, $25,000, $4,000, $100,000, $15,000, with consideration of a physical allocation in allocated storage outside the financial system. The third category requires a precise distinction, because confusing the 2 instruments here is one of the most expensive mistakes you can make in this environment. Long-duration treasury bonds, 30-year treasuries, long-term bond funds, are destroyed by rising inflation and stagnant rates. In 2022, long-duration bond funds lost between 20 and 30% of their value while rates moved. The investors holding them believed they were in the defensive portion of their portfolio. They were in the most exposed portion. The standard 60-40 portfolio, 60% equities, 40% bonds, was built for an environment where bonds and equities move in opposite directions. That correlation held from 1980 through 2021 because inflation was structurally falling. In stagflation, the correlation breaks. Both fall together. The 40% that was supposed to protect becomes the 40% that accelerates the damage. Short-duration instruments and Treasury inflation-protected securities work opposite to this. SCHP, the Schwab U.S. TIPS ETF, adjusts principal automatically as inflation rises. BIL gives cash-equivalent yield with zero duration risk. Short-duration instruments mature quickly and roll into new, higher yields. In a stagflation environment where the Fed is structurally blocked from cutting rates, these two instruments behave defensively. Long-duration bonds behave as the risk asset. Target 15 to 20% of total portfolio in short-duration fixed income. 10,000, 1,500 to 2,000 across SCHP and BIL. 25,000, 4 to 5,000. 100,000, 15 to 20,000. Full alternative ticker list is in the description. The fourth category is the one Dalio has discussed most directly over the last 6 months, and the one most domestic investors are most underexposed to: international diversification away from concentrated U.S. dollar exposure. The most accessible broad instrument is VXS, the Vanguard Total International Stock ETF. For direct emerging market exposure, VWO. Here is the data. In 2025, the MSCI Emerging Markets Index returned 33% in dollar terms. The S&P 500 returned 16%. The MSCI Europe Index returned 21%. MSCI Japan 19%. Every major international index outperformed the U.S. by meaningful margins, not because international economies suddenly became dramatically stronger, but because the dollar weakened against their currencies and foreign-denominated assets became worth more in dollar terms automatically. Dalio's own words on this from a recent interview: there were big shifts in flows, values, and in turn, wealth away from the U.S., and what is happening will probably lead to more rebalancing and diversifying. He was not predicting. He was reporting what institutional capital is already doing. This is exactly what happened across 1973 to 1980, when international equities outperformed U.S. equities by margins that took 2 full decades to reverse. Target 15% of total portfolio in international exposure, 10,000, 1,500 in VXUS, 25,000, 4,000 split between VXUS and a smaller VWO position, 100,000, 15,000 across VXUS, VWO, and the regional ETFs listed in the description. Now here is the timing piece, and this is the part most people will underestimate. Kevin Warsh's Senate confirmation vote is this week or next, depending on floor scheduling. He becomes Fed chair on May 15th. His first FOMC meeting as chair is June 16th and 17th. By that point, the institutional repositioning this framework describes will be visible in price action. Gold will have moved. Energy will have moved. The window where retail investors can position alongside institutional capital before the price action confirms the thesis publicly on every financial news screen is approximately 40 days. In normal monetary transitions, the gap between the institutional signal and the retail price confirmation is 6 to 12 months. In this transition, because the catalysts are a single Senate confirmation vote followed by a single FOMC meeting 6 weeks later, that gap compresses to 40 days. 40 days from now, the position that costs you $100 today will cost you more, not as a prediction. As the documented behavior of capital markets in every prior instance where this configuration appeared, the data is not hidden. 3 Fed presidents dissented in writing. Powell is staying as a governor through 2028. Miran is being pushed out. The Senate confirmation vote is days away. The fiscal math, $7 trillion in spending, $5 trillion in revenue, has not changed. Dalio confirmed stagflation in writing. The four asset categories with documented outperformance across every matching historical episode are accessible in any standard brokerage account today. There are two kinds of people finishing this video. The ones who will open their brokerage in the next 72 hours, compare their current allocations against the four categories just described, and make at least one specific change. And the ones who will close this, feel informed, and do exactly what they were already doing. The savers in 1979 had the same data available to them that you have right now. The ones who acted are still wealthy. The ones who waited are still working. Decide which one you are. If this changed how you're thinking about what just happened on April 29th, share it with one person whose financial future you actually care about. That is the only thing that gets analysis like this to the people who need it. The next video covers the precise entry timing for each of these four positions over the next 4 weeks, tied specifically to the Warsh confirmation calendar and the June FOMC window. Subscribe so you don't miss the week that matters most. No aggressive pitch, just the next piece of the framework when it's ready. The math is not opinion. The instruments are accessible. The window is open.